Peter Hugg, you called it the Fed sticking with 3 rate hikes and gold rallied on the news. But where is the metal headed now? How do you see gold set up?
Well, we got the rally the other day. I think that was primarily based on the jargon that was going back and forth between the White House and China on the tariffs that China now has imposed on U.S. goods. That spooked the stock market a little and created some safe haven buying in gold as the dollar took it on the chin when that announcement came out on the China tariffs. Now we're looking at today, and the market has basically reversed about 50% of the gains since that announcement on the Chinese tariffs. They believe that Trump's more bluster than his bark is worse than his bite, and they don't think it's going to be as serious. Got a rebound in the stock market, and people took profits in gold. I mean, it's a very difficult market from an investor's perspective. Investors, I believe, should hold their percentage allocation in gold. There's just too much out there that can go wrong. From a trader's perspective, you've just got to, trade support and resistance lines, and once it breaks through levels, you've got to take the appropriate action to protect your position.
Now, Pete, I know you've said in the past that we're just not seeing the physical demand, especially coming out of North America. Do you think we'll see a turnaround anytime soon?
Again, I've had this question asked of me a number of times over the past 6 months. I do believe that physical demand will reappear, but I think it will only reappear once we've broken through some significant levels. And, I think the retail investor has been, quite frankly, from a perspective of trading this market, been burnt. Every time the market rallies, it falls back, and they just don't trust the market. Until we have a breakout above 1365, which then ushers in 1400, or a breakdown below 1275, I think the retail investor remains cautious in this market.
So looking long term, Peter, does a steeper yield curve mean higher real rates and lower gold?
That's possible. My concern isn't so much the Fed on their aggressive posture. Again, I'm not in the camp that is looking for 4 rate hikes this year. I'm not even sure we're going to see 3, but let's leave it at 3. I think it'll be gradual. That doesn't scare me as much as what I'm seeing in the LIBOR rate, which is the interbank lending rate, which has really moved up significantly over the past 3 months. Now, if that starts to choke off credit facilities at the retail level, that could create a problem. And again, that would indicate some serious issues with the financial sector of the market. So I'm still watching LIBOR. It's making me a bit nervous. But as rates go higher, again, from a fundamental perspective, I don't think gold has any business being at 1350 right now. I think it should be lower. But what's happening is that there's just enough fear out there that's creating a floor under gold. And you can always count on the president to make some statement that just jars the markets enough to scare investors back into gold. So I think there's a base on gold. I'm not one of these analysts calling for $1,100, $1,200 gold. But the upside impulse, I think, is going to require something. And I think that may still come. But the retail investor right now is just not enamored with the market. And is basically out. So I'm still not seeing any retail demand on the physical side in North America.
All right, Peter Hugg, thank you so much for your thoughts.
You're welcome.
And thank you for watching. We'll be back tomorrow.